Welcome everyone to the trading week of March 24th through 28th. So I've given you guys the reason why there's no report this week, but to keep a long story short, I am in the midst of a very hectic situation regarding my dear grandmother. But I don't want to start this video on a low note, so I want to thank everyone for the amazing messages and support that you guys have sent and shown me for the past few days. Now, in this technical analysis video, I want to give you guys some swing trade ideas that can work out very well this week and possibly in the next couple of weeks, along with some on-the-spot option contracts or even spreads to look at for each swing trade idea. So with that in mind, let's kick this video off with a market review on ticker symbol SPY or the S&P 500 ETF. So as seen here on your guys' screen, we have the weekly time frame of ticker symbol SPY. Now I want to hone in here because last week we ended up closing slightly below the weekly 50 SMA, this dark blue line, and this matters. Why? Well, first of all, the previous week before that was the initial touch and retest of the weekly 50 SMA, and then the following very quick move down and an immediate snap back up higher to get very close to the weekly 50 SMA once more. Now this tends to happen a lot at very significant long-term SMAs where the price retests it and then breaks below it and then an immediate snap back up higher to get right back over that specific long-term SMA. Now, what usually tends to happen after this type of a candlestick appears on a very major long-term SMA is that the following week shows a continuation back to the upside. However, last week we didn't do that and we ended up closing right below the weekly 50 SMA due to increased volatility. Now, what's interesting about this is that, well, even if the price did end up closing below the weekly 50 SMA, we still have some signs that we're about to see an intermittent bottom forming here to give us a very nice bounce back up higher and a very much needed one at that as well. Now, here's the question to ask. So how far can this intermittent bounce go? Well, first of all, we have to take a look at the weekly 10 and the weekly 21 SMAs because we just had our very first bearish crossover, right? This is the official bearish crossover that we've had ever since, well, this entire previous bull market began in 2023, right? So this bearish crossover obviously is not good, and we would much rather have an ideal scenario where we have a very good V-shaped recovery where we have just a straight up movement for the next couple of weeks rather, and completely negate this bearish crossover of the daily 10 moving below the weekly's 21 SMA, right? So now with this reality on our hands, I would say from a personal subjective perspective based on my technical analysis and based on my weekly SMAs here, the short-term momentum SMAs, okay, I would say the maximum of the price, or maximum range of where the price can go to during an ideal bounce would be around 585 to maybe even 588. So nice 3-point range. Now, that would mean that we would have to get past the previous 574.50 support level, or again, you guys can just simply round up to 575, and all the other supply areas and levels that we need to get past from these large moves lower that we saw on the weekly time frame, especially on this weekly candlestick. And so there's still a lot of sellers present even just 2 weeks ago, right? I mean, we've seen this already happening because of last week's action, right? There's a lot of supply around this 568 level as well. And so with this amount of supply overhead, the buyers will have to do a lot of good bidding and come in droves to try to make sure that they can, again, have a definitive move back up higher and eventually break over these previous significant support levels, right? Again, these are the previous downside targets that I've had where the price was able to completely reach them at a very fast pace and eventually break below the maximum level that I thought the price can go down to. But again, if we can flip these levels here in the next couple of weeks to supports again, since they're now resistances, we should be good to go for a very nice intermittent bounce. But again, from an ideal perspective, I would say we could be hitting 585 to 588, which would also give us a retest either at the weekly 10 or the weekly 21 SMAs. Now, before I go into the swing trade ideas, I really want you guys to remember that the price can either gravitate towards the SMAs, the short-term SMAs first, or it can just slowly hang out and consolidate above or below the weekly 50 SMA, or slowly move back up higher with higher highs and higher lows that aren't too volatile, right? And what I mean by that is, well, each single weekly candlestick is not showing wide price ranges from its lows to its highs. Okay, so with all of that in mind, let's take a look at the first swing trade idea for this week, FCX. So I've already given you guys a quick breakdown, well, I would say a more detailed breakdown in the private CFO Discord chat room, so make sure you guys take a look at the CFO Trade Ideas channel. All right, so FCX. Okay, the first thing that I noticed so far across all the other copper names like FCX is that, well, it's making a very nice broadening wedge chart pattern as seen by these two purple trend lines. And again, a broadening wedge chart pattern is created by a nice ascending resistance trend line and a very nice descending support trend line. Okay, and so far it seems like we're about to see a potential breakout out of this broadening wedge chart pattern. And why do I think it's a breakout to the upside? Well, these broadening wedges tend to form near a bottom after a major downtrend, and so far FCX has been moving lower since last year in May. Okay, and so FCX may be looking for an official turnaround for a potential run up for the next couple of weeks or maybe even the next couple of months. And on top of that, I've given you guys reasons as to why we think, well, we should think copper prices can continue to surge up higher. So please read what I've typed out in the CFO Discord chat room. Okay, and specifically in the CFO Trade Ideas channel. So with this broadening wedge, if we're able to at least hold over $41, there's a good chance the price can come back up to this ascending resistance trend line and retest it for a fourth time, which could eventually give us that very nice breakout and ultimately a retest of the daily 200 SMA that is still curling downward to catch up to the price. And so with the price acting very well for the last week and a half or so of trading, we should be able to see the price still consolidating between around 39.20 to around 41, and eventually it should provide enough energy to catapult the price back over 41 and eventually out of this overall broadening wedge chart pattern. Now, what I like about the last week and a half or so price action is that, well, the very nice pivot from this $35 support level. This is a major support level that I've mentioned a couple of times on FCX here, including the report from last week, I believe, or even last week, if I'm mistaken, is that this pivot here has allowed the price to get back up over the major SMAs on the daily time frame, the daily 10, the daily 21, and the daily 50 SMA. So that is a very significant change to the price trend and even the price action itself, as the price continued to stay over the daily 50 and has continued to move up higher with higher highs and higher lows, giving us an official textbook uptrend. Now, last Friday was more of an ideal early bounce entry for me, over $39, since that was the initial entry point that I given you guys in the report. So, or last week's report, even last week's report, if I remember. And so this $39 level was literally a very good picture perfect entry point, but again, it's a lot better to wait for that confirmation. So as long as we're able to break over 41 and continue to move to the upside, we should be good for a long-term move back up higher, back towards 45, and even possibly back to the 50s. Okay, so with that technical analysis in mind, let's take a look at the option contracts. Okay, so let's take a look at the April 17th expiration date. Okay, so I want to go out at least into the next month's expiration, right? The OPEX date for the monthly OPEX date for April, which is April 17th, and we see a lot of active options activity going on here. So let me stretch this out further. Okay, and so there's a lot of call activity going on, even though there's a significant amount of puts as well, but calls are a lot more active here based on the volume and most importantly the open interest. So I really like how the at the money strike, right, the $40 strike call contract looks on the open interest and the volume as well. So this is a very liquid contract to look at. Now, what has also caught my eye is the 45 and 44 strike call contracts, because based on the open interest, we may be seeing some sort of a spread being opened here, or has been opened using these two contracts. So I don't know if it's a spread or not, but just simply based on the open interest, maybe someone has bought outright 5,000 contracts to open up a spread using the 45 and 45 strike call contracts. And in this case, if I were to do a spread, I guess I don't know why I would do that, since the option contracts premiums for each of these two strikes are very, very cheap, right, relatively speaking. So if I have done a vertical spread on these two strike contracts, or these contracts here, it'll be very, very cheap, right? So all you have to do would be to subtract the premium price on the bought contract of 44 strike call contract and the sold contract on the 45 strike call contract, right? Because again, you'll be selling the 45 strike to finance the buying of 44, right? This 44 strike call contract. So for me, on the April 17th, I will most likely just going to be focusing on the naked contract of the 40 strike call contract. I mean, this is just an at the money strike as well. So it will be very, very deep in the money if we're able to break over 41 and have that very nice breakout, just to even a retest of the daily 200 SMA as seen here on the yellow line, right? Now, if anyone wants to go out further, maybe even into near the end of quarter two, or even just leading up into the end of quarter two, I would try to take a look at at least June 20th or even July 18th if you want to take a look into the summer months. But June 20th, or I guess later into the summer months, but June 20th is still a very good option as well for the expiration date, and we still see a lot of heavy call skew on this expiration date, specifically that 45 strike call contract. And I would choose this specific naked call contract if we were to assume, or at least be able to see a favorable price action to the upside, where it looks like it's about to catapult into the 50s, right, as I've mentioned earlier as well. And this 45 strike call contract will be very, very deep in the money if the price is able to go up to even just near to $50, maybe even back to 49 or 48 as seen here. Okay, so again, if you guys want to go out further and not have to worry about the day-to-day fluctuations and volatility on copper prices, this one would be the contract to be looking at, this 45 strike call contract on the June 20th expiration date. Alright, so that is it for FCX. Let's take a look at the second and final swing trade idea for this week. Okay, CAVA. Right, so CAVA has been absolutely decimated by short sellers for the past couple of weeks, including last month as well. And earnings did not do the buyers a favor here, because even after earnings, sellers continued to hit that sell button over and over again, leading towards the price falling continuously to the downside, making a very textbook, but at the same time momentum-filled downtrend. And this downtrend seems to be stopping for now, because on a short-term perspective, last week, starting from last Wednesday, we had a nice higher high and higher low pivot, which could potentially indicate that we could be seeing, at the minimum, sideways price action to completely stop this bleeding that we've been seeing for the past couple of weeks, right? And that's all we want to see, because if we do see some base forming between the $75 to at least around $87, there's a potential for the price to reach a maximum range level of $97.50. Now, why does this matter? Well, in order to figure that out, let's take a look at the weekly time frame. So this $75 level and this 97.50 whole number level was initially formed all the way back over here, right? So last year in June, all the way up into August, where we had an official breakout over $97.50. Now, this really matters because, well, the price has respected yet again the $75 level. And if we're able to consolidate further sideways right underneath this midpoint-ish level of 87.20-ish, or again, if you just want to use a whole number and round down to $87, that's fine. So if we're able to consolidate between 75 to 87, there's a good possibility that the price can try to reach back up towards this 97.50 level, this maximum range. And on the weekly time frame, if that does occur, then there's a good chance that we can be seeing a retest, a coinciding retest of 97.50 with the weekly 10 SMA, which is slowly starting to catch up on the weekly time frame. So I would assume that if the price is able to break back up over 87 and eventually stay over the whole number level or whole level number of $90, then the weekly 10 should be around somewhere below the weekly 50 SMA. So at that point, I would assume that there has been a bearish crossover of the weekly 10 breaking below the weekly 50 SMA. All right, again, if you guys are wondering how I'm able to predict at this point in time of my SMAs on any time frame, well, just as I've said many times before in the past, I just have 8+ experience using my SMAs along with the price action. Okay, so with all that in mind, for CAVA, I would say using some vertical spreads on options can quite be a very good possibility. But first, let's take a look at the actual naked option contracts first. Okay, so for CAVA, I just want to go out to, let's say around May 16th. Or actually, let's take a look at April 17th. Okay, so the next monthly OPEX expiration date, right? So for CAVA, things are still looking very bearish, right? We're seeing a lot of puts still being bought and held, as seen here on the April 17th strike. I mean, there's obviously a lot more out the money call contracts that people have been holding, which will most likely become worthless by expiration, and they will most likely have lost all their money on these contracts due to that huge move down that we've been seeing so far for the past couple of weeks, right? So all of these out the money, very out the money contracts that have a significant amount of open interest in the thousands, you should most likely just ignore them. I mean, these will all be failures of a trade that people just try to hold on to, or maybe they're just call sellers collecting premium, who knows, right? And I wouldn't have been surprised if the premium on these out the money contracts were very high for them to choose to sell these call contracts. But either way, these out the money strikes will most likely be closing worthless, and the contracts will be done once this expiration comes by. So I would try to take a look at the levels, the levels here on the technical analysis that I've shown you guys, and apply it towards the strike for the call contracts, right? So for me, I would want to look at the 95, 90, and 85 strike call contracts, and especially when it comes to spread. When it comes to the spread, I would try to choose, at least between 95 to 90, or if you want to cover this 97.50 level, this potential maximum resistance level that the price could potentially reach before it starts to make a larger consolidation, okay, compared to the consolidation that I want to see between 75 and 87.20. I would say using the strike 100 and 95 could potentially be a good one for a vertical spread trade. So basically, again, you would sell the 100 strike call contract to finance the buying of the 95 strike call contract, and this would be a very nice 5-point spread on that vertical debit spread, right? So now here's the thing, okay, regarding the actual technical analysis for CAVA. If you go on the weekly time frame yet again, there is a good chance that we could be seeing a very large macro inverted, not inverted, a head and shoulders chart pattern, right? So what I mean by that as well, first of all, this previous range that we made here back in June to August between 75 to 97.50 will be our left shoulder, okay? And then this entire kind of U-turn that it did here, right, from the initial breakout in early to mid-August and all the up into last month's complete waterfall move down, could be the actual head that has been formed here, right? So a massive head that we could potentially be seeing here for the future. And based on what I've told you guys now for the short-term future, if the price decides to hit this maximum range of 97.50, this resistance level, and continue to start ranging between 75 and 97.50, just like it did back here, there could be a chance that we could be seeing a formation of the right shoulder, giving us that completion of the overall head and shoulders chart pattern. And again, this is a bearish chart pattern. So maybe in the next, few weeks, the next couple of months, so from a short to mid-term perspective, and when I say months, maybe in the next maximum 2 months, we could possibly be seeing the formation of a right shoulder. All right, so again, don't forget about this potential head and shoulders chart pattern that could continue this current downtrend that we've been seeing. All right, but for the meantime, in the meantime here, we are most likely ready for a nice oversold bounce. All right. Okay, so with that in mind too, that potential head and shoulders chart pattern, if you want to go all the way out into maybe even June, okay, so mid-year, you can focus on some puts, right? But again, seems like there isn't a lot of activity going on in June 20th, so maybe even go out even further to July, all right? And we can definitely see a lot more strikes and a lot more interest in both the calls and the put side. So, regarding the puts for July 18th, especially if we do see this right shoulder being formed, we can touch base back on that once that does occur, especially if the price decides to consolidate between 75 and 97.50. But again, just keep in mind that there could be a potential for the price to make this very large macro head and shoulders chart pattern. All right. Okay, so that is it for this video, right? So if this technical analysis video was insightful and most importantly applicable, make sure you guys smash that like button down below. And if you're new here and you aren't subscribed to the channel, make sure you guys hit that subscribe button as well. But also, if you're watching this video when it just became public and you would like to watch this video a day earlier when it's private, the only thing that you need to do is become one of the many readers of the CFO Swinger Watch Report, which will automatically give you access to the private CFO Discord community where you can expedite and further your learning in trading. And more information can be found using the actual link to the CFO Swinger Watch Report down in the description box below. So make sure you guys read the description box as well. But if you have any questions, or if you have any questions regarding any type of discount that you guys would like to have for your first 30 days, please DM me on Instagram at chartsfocus1. And again, if you guys don't know how to spell that, well, just take a look at the username for this YouTube channel. Good luck, and I'll see you all tomorrow morning.